So I'm going to talk to you about day trading futures today. Um, and it all starts with the question of, aren't futures dangerous? Which is pretty much where I started with. Aren't futures dangerous? And the answer is absolutely, because you can trade them on margin, and it's a relatively small margin to make huge gains, because we'll talk about how much gains you can make with trading futures. But you're trading them on margin. It's not like you're putting your cash down on the table and you can only lose what you're spending. The losses can add up just as quickly as the gains. Um, but it doesn't have to be dangerous. It just takes knowledge and skill and the right tools. These are the things I didn't have last year, okay? So last year I lost about 50% of my account by trading the futures. I was blinded by the money that could be made, and all these talking heads, as Andrew mentioned, on CNBC and Bloomberg and other places, talking about how crude was going up. This was when crude was trading at about 105, 107, and they said 120, 130. We're going. This is you know ISIS has taken us through the roof on oil prices. So I went long futures, a lot of contracts of them. Well, 107 was the high tick of last year, if I remember correctly. And where are we now? Around 49, 48. So that didn't work. They also said the 30-year bonds were going down because the feds were going to raise interest rates. They just have to. They just have to. Well, they didn't go down. So I was in the bonds around, I think, the 125 level, and we're trading now at the 150s, something like that. So obviously that didn't work out either. And enough's enough. I don't watch the talking heads anymore. I literally don't watch CNBC anymore, right? Oh, someone asked, for them it starts with, what is a future? That's a perfectly good question. As I try to rush through my shortened time here, people who come to my webinars on Saturdays know I can talk for 2 hours. Andrew's like, you have an hour, don't go over. Okay, so anyway, what is a future? A future is a derivative contract, much like an option, because it's a derivative based on an underlying, but it's all about what the future speculative price is of the S&Ps or gold or crude. It was developed for those like oil producers to use to hedge their oil that they're producing. They can sell it now. The oil that they're going to be taking out of the ground, they can go ahead and sell it now for the market price in order to lock it in, or if they think it's going to go lower, or they can buy it at the market price to lock in that price, et cetera, if they think it's going to go higher. So it's all hedging. That's what it was created for, but it's very much a speculative instrument as well. So to me, I lost all that, and losses are educational fees. If I hadn't lost so much, I wouldn't have learned so much. But however, I want nothing more than to save others, save you from that experience. What changed things around for me was learning about technical analysis, building my own technical tools, because I no longer want other people's ideas, okay? I want my own ideas. I want to own my own decisions and my own trades. I'll take, if somebody's talking about something, I'll look at it, but the trade and the decision is going to be my own. I also needed to learn how each future contract behaves, what drives it, what's it correlated to, what to be cautious of, et cetera, et cetera. So today we'll be talking about all of this. I'll share with you the knowledge I have about S&P mini futures, crude futures, and euro futures, and the technical tools that I've built to give me the edge I now use to make great day trading profits in the futures. So why day trade futures? Well, futures are traded 23 hours a day during the week and starting on Sunday nights. So they're open more than the regular market, okay? So the Asian markets, the European markets, and the American markets are all influencing the futures. They're open all the time. It's a good way to, even if you're not trading them, you watch them and you get a sense of how the next market day is going to go. Okay, leverage is also a great feature. Many brokers allow you to special day trading margin, which means during normal trading hours, one may trade a future long or short with very little capital required. For example, some brokers will allow you to trade the S&Ps with about $500 per contract margin requirement in either direction. Now, if you hold it past regular market hours, the CME requires actually the margin to go up to about roughly 5,000 per contract. So and we'll talk about this, a lot of traders who are day trading won't be holding those overnight. So this allows for large gains off little buying power reduction. However, it also leaves oneself open to larger than expected losses since one is using margin to trade, so something to be aware of. The other reason to day trade futures, liquidity. Today we'll be looking again at the S&Ps, crude, and the euro because at the moment they are some of the most liquid active products in the futures space. They're great for technical analysis. Because of the aforementioned liquidity slash volume, the futures tend to respond to technical analysis very whatever that indicator may be, MACD, RSI, simple moving averages, exponential moving averages, Bollinger Bands, and especially my own tools, the market web value areas, Alpha Tracker, Orb Study, etc. And research. Futures typically fall into one of four categories: indices, currencies, commodities, and fixed income, right? Given this fact, the quote unquote internals of the product is easier to see in real time than, for instance, say the accounting books of an equity company, right? They're not gonna show you, you can't just bring up Bloomberg to my knowledge. I don't have a Bloomberg terminal, but I don't believe that you can bring up Bloomberg and look at their financial books that are updating in real time to see what they're spending their money on, what their income is that sort of thing. But with the futures and all of these different categories, you can actually see the internals that are driving them and give yourself an edge here too. Okay, so some rules I like to keep in mind. While day trading, I will only enter the position if I can, at the same time of entry, have a defined stop level in place and a defined target. This gives me a requisite risk versus reward setup for a trade. Okay, so I'm only going to get into a trade if I know I can have a tight stop, maybe 2-3 points in the S&Ps, and a potential target of 5, 6 to 10 points, right? So the potential reward is higher than the potential risk. Otherwise, I'll wait for another trade. Also, some more rules. Trading futures at the Globex, that's the extended hours session, is extremely difficult. Algorithms are running the show and can cause quick movements or very little movement, which can be far, far worse. Nothing worse than getting into a trade at 6 p.m. Eastern because you're like, yeah, I'll just sling some futures tonight before going to bed, and nothing happens. Nothing. Then you tighten your stop, you go to bed, and you hope for the best. And as soon as you go to bed at midnight, the algos come out and they run all the stops that everybody did. Happens all the time. Swing trading futures can be very lucrative. Okay, you can get big points if you can really call that, crude is going down from the end of October to the end of December and it's never coming back up. That can be very lucrative, but I never want to do this without protecting my position with options. So if I'm long, I'll buy offsetting puts, or if I'm short, I will buy offsetting calls, or I'll sell, options around it, just like I would with an equity. But it's better than using stops. So here's a little chart that I put together about these three particular instruments that we're going to talk about today. So the S&Ps, there's 4 ticks per point, each tick 12.50, okay? Each point, therefore, because there's 4 of them, $50 per point. The average true range of the S&Ps right now, as of yesterday, 22.41 points. So per contract on an average day, about $1,100 per contract, right? Regular trading hours, just like the market, except it goes to 4:15. And then the global trading hours, you can go there. I don't want to take up too much time. It's all read here. This is being recorded, so you can always go back and reference all this stuff. But I just want to talk about that. If you look through the average, I think I really want to highlight this. If you look through the average true range, you can kind of see roughly per contract basis, expect to make about 1,000 per contract if you can take the whole average true range out of a day. Okay. Other things to note, and we'll get into the specifics here as I talk about each one more specifically, is there are different trading hours for each instrument. That's because each of these three are in different categories. S&Ps are indices, crude is a commodity, Euro futures is currencies / fixed income, right? So different trading hours, different Globex session hours. Everything does start back up at Sunday night at 6 p.m. Things to look at with the S&P mini futures. Things that are directly correlated. The Dow, the Russell, the NASDAQ. You can do futures on them as well. Things that I look at, and I will go into more detail about this, UVol versus DVol. That's up volume versus down volume. Advancers versus decliners. So stocks that are moving up versus stocks that are moving down. The ticks, you've probably heard about that. UVol divided by DVol. That's hard to gathers information about, so don't pay too much attention to it. You can get studies for it online or whatever, but don't worry too much about it. Inversely correlated. These are things that the market will go down if these go up. VIX, bonds. Really, really important to keep an eye on those, okay? Important times and events, midday data events, unforeseen news, FOMC announcements, earnings reports can all move the S&Ps, okay? For crude, the directly correlated are going to be commodities and metals, because crude is a pair basically with the dollar, okay? But it's a mild correlation these days. Crude is really driven by supply and demand curves, much more so. So you kind of want to keep more an eye on the same kind of things. So nat gas, that's / NG, gasoline, RB, heating oil / HO, okay? Important times and events, API numbers Tuesdays at 4:35 p.m. Eastern, EIA numbers Wednesdays at 10:30 a.m. Eastern, and then the 11:30 a.m. European close. And I'll talk about these things in more detail as we go further. Euro futures, again, currencies, metals, bonds, these are going to be the directly correlated, and inversely correlated is going to be strongly the dollar index, because the dollar index is made up about 60% of the euro. So if the dollar is going down, guess what the euro is going to do? It's going to go up. And conversely, every time I get an orb breakout signal for the dollar, like a buy signal, I get immediately, like 5 minutes later or sooner, a sell signal on the euro, and vice versa. Overnight data events can move this, also the European close. So let's start off, and I know I'm going fast here, but I just want to get all of my brain dump in as fast as possible here. So day trading the S&P mini futures specifically. The ES will move in direct correlation, as I said, with the Dow, the Russell, the NASDAQ. Some days one or the other will be stronger or weaker than the others, okay? So today we'll be looking at the ES, but say in a strong day where all the markets are moving up, one may want to focus simply on trading the strongest index. And you can kind of look at, you'll get a sense, if you watch all four of these on a daily basis, you'll get a sense of relatively what they should be moving at, and one will always stand out as moving more than the others, right? So on a strong day, I want to take the strongest index, and on a weak day, I want to take the weakest index, because those will move faster than the others. Conversely, the ES will move in indirect correlation with the 30-year bond, 10-year notes, or the VIX futures. Notably, during an inside day with no huge movement in the indices, like the ES or the Dow or Russell, whatever, so no huge movement, just kind of chop, the alternative instruments, the bonds and the VIX, will tend to flinch first in one direction or the other. So if I keep an eye on those and what they're doing, they will give me a quick hint to take a quick scalp out of the indices, okay? If the ES is barely moving and the VIX starts to moving up, look for the ES to move down, etc. If the ES is in a strong momentum day, those alternative instruments will move second, and therefore they're less useful, okay? They're just good for confirming a directional move. Other notes, because the ES is one of the most highly traded futures product, and most traders are day trading it using those intraday margin reliefs, there tends to be covering near the closing moments. So that's around 4:15 p.m. Eastern. I think a lot of brokers need everybody out by 4 o'clock Eastern. Some brokers will allow them until the 4:15 close. So around that time, and usually around 3:50 Eastern onward, you're going to see a lot of covering action. So if the ES has moved down all day, look for an up move on the close, or the opposite in an up day, okay? The ES will not move much in the Globex session until the European session opens, very early in the Eastern time zone. Sometimes China and the Asian markets can move it, but rarely. They're much more focused on the Nikkei futures and also the currency futures, or anything where they feel like they can run some stops. Crude is also something that they'll go and manipulate. It's not a good tool, therefore, for trading at night before going to bed, unless there's some major news events at play. I can already tell on my calendar that I will be trading the S&P futures at night when we get closer and closer to the presidential election, okay? Or if there's a gap on a Sunday night, we've seen that recently with all the Greece news, a lot of gap downs on a Sunday night. The S&Ps is a great tool to be trading on Sunday nights. So here's something I want to talk about, and these are the market internals of the indices. I mentioned the ticks, the UVol minus DVol, and the advancers versus decliners. I've listed over here on the far right the priority I put on those. Okay, first priority is advancers versus decliners. That's the number one priority that I look at, followed then by UVol minus DVol, and third and least priority is the ticks. Now, a lot of people think that the ticks have the most priority, and I find that completely wrong, because the ticks are going to be your immediate, like your intra-second. If you're trading on a 1 minute, fine, use the ticks. But if you're trading on a 5 minute and you're looking for nice 5 to 10 point moves in your play, the ticks are the least important to you, except for maybe taking an entry, right? If I'm taking to the short side, I want to wait for a high tick, but the ticks move so fast. I don't don't pay much attention to the ticks during the day. It's the advancers versus decliners. So those are the amount of stocks that are moving up today versus the amount of stocks that are moving down today. And up volume versus down volume, the amount of volume on the buy side and the amount of volume on the sell side. Those are more important to me, and those are tracking the market internals. So something that I look at and how I use it. I draw these lines here. Again, on the right, you can see these lines. And you can kind of see trend lines. Around 10:30 every day, somewhere between 10 and 11, but very close usually to 10:30, you will see a significant turning point in the advancers, decliners, and the U-vol, D-vol. So that's after the first hour of the day. And I'm drawing these trend lines from that moment. And then through to the end of the day. We can see for this is for the entire week that we had, the regular trading hours of this week. And under U-vol, D-vol, we can see that those trend lines were down all 5 days. On advancers, decliners, which is the most important to me, look on Monday, it's up. Okay, so we have a disagreement there, and that's very, very important. And I've drawn this here. There's a disagreement between the U-vol, D-vol, advancers, decliners, and the U-vol, D-vol. What that means is that there's a move coming. The up move, this S&Ps actually did move up on that day. It's hard to see in this little graphic, but they did move up on that day. That meant that something, the disagreement between the U-vol, D-vol, and the advancers, decliners means that there's going to be some kind of move coming, right? We know now in hindsight that it meant that we were going down. Alpha Tracker actually told me that we were going down before the end of the day on Monday, so I was able to kind of head that off at the pass, and I'll talk about that in a minute. Other things I look for is if those trend lines on the U-vol, D-vol, and advancers, decliners are relatively flat, and they are especially on Wednesday on the U-vol, D-vol, that means we're going to have a lot of chop. If you look at the Wednesday chart here, not a whole lot of movement all day. When the trend lines are steep to the downside or to the upside, that's a great day for profits. That's going to be a high momentum moving day. Thursday, Friday, well, we all know Friday we were down roughly like 25 points, so massive, massive sell-off. So these are the things that I look at as far as the market internals when I'm just looking at the S&Ps. I've told you other instruments you can look at, but the one thing that's really great about trading the S&Ps is I can see what the market is doing inside of itself and get even more information. It's kind of like seeing, if you're trading a retail stock, kind of like seeing how many people are buying today. Well, no one's buying their product today because they overpriced everything. Well, okay, I'm going to short it today because it's probably going to go down, et cetera, et cetera. It's like that kind of real-time evaluation of the strength and the weakness in the market. Really, really cool stuff. But so the technical side aside, I want to talk about the other stuff that I use. Okay, and these are my two indicators, the two things that I look at the most, the market webs and the Alpha Tracker. The Alpha Tracker, brand new from us. That's going to be the big thing that I talk about today. But just starting out, looking, if I'm going to day trade the futures, I want to be on the side of the broader time frames as well. So if I'm looking at the broader time frame, and here on the market webs, I can look at a 1 hour chart in the upper left corner, a weekly bar chart in the upper right corner, and a daily chart in the lower right corner. I can see weakness in all three of these. That means I don't want to be looking for long plays in the 5 minute on a day trade. I want to be looking for short plays, okay? So I already knew going into this week that I wasn't looking for any longs, okay? Because everything was looking very, very weak. Okay, so that's something that I look at. It's very, very important for me to keep an eye on the overall market, the actual larger trends if I'm day trading within those trends, because the larger trend will drive the smaller ones. Now, the Alpha Tracker, this is what I was mentioning earlier. This is, like I said, the newest indicator that I've come out with. And what it's doing is it's detecting large players in the market. Fausto was on here earlier, and he was talking about seeing these big gargantuan orders come in on the level 3s or whatever. Well, Thinkorswim doesn't allow me to see those all the time. They will be there to some extent, but there's a lot of tricks and tools that traders can use and algorithms that they can use to hide those kind of orders so that nobody else is seeing them. I wanted to develop something that wouldn't allow them to hide from me anymore, and I wanted something that I could see on a chart and chart it instead of just looking at level 3s, which disappear as soon as they're done, right? So I created Alpha Tracker, which does the same kind of thing. It detects large players in the market, large orders that cause resistance or large orders that will move the market in a certain direction. Lines created on the chart, okay, on the upper chart, are called defensive lines. That's big money drawing a line in the sand with certain orders. So we can see here on the far left, and this would have been on Tuesday during regular trading hours, large buyers came in and bought 20,000 contracts in the S&Ps. So I see buyers supporting. So if I'm short and I see that order come in, close my shorts. I'm out of the pool, jump, okay? And then Globex session, I've already talked about how the ES is not a good tool for Globex session, so I stay out of it. Then the next day, we open below that line, we come up to it, and we have a hard time breaking it. We try to break it early on in the day, but after that 10:30 mark, we stay below it. So shorts, it's a short signal because the line can't be broken. I can place my stop above that line after I get confirmation that we're not going to break above early on, okay? But then, so I take a short there and I stop above that line, good risk to reward, and I wait for buyers to step in again. Here they are. They come in, they step in there with 10,000 contracts. Great, I'm out of my short. Not a great day, not a huge day. We already talked about those, the UVOL, DVOL, and Advanced Decliner lines were pretty flat, so it was just going to be a chop day anyway. I took what I could get and I'm out. And it was like a 4-point profit, right? Again, I'm not trading the Globex. And here on Thursday, we break below that line. Once again, we come down to the bottom of value, come back to that line, test it, no trading above it. Again, take a short and put my stop above it and really do well. Okay, so this is from the 209 level down to the 2198 level, right? And then it comes up, and do buyers come in? No, sellers come in. Alpha Tracker shows me more selling, 15,000 contracts, marking a line in the sand, more sellers. And that gives me a new resistance line. So now I have a question, I have a quandary, right? Do I want to hold? Do I want to get out at the end of the day, or do I want to hold? Well, I can hold on to this, and by the end of the day, we go even further to about 2093, 2094. Okay, and then I can close to avoid the overnight margins, or I could even hold and move my stop to above this new resistance line. And if we can see there, it's kind of gray, but over on the right, that line held, and they couldn't get above that line. So I can move my stop down. Maybe I can buy some options to protect my short position, so I buy some calls or whatever. And therefore, you know, I can stay in this trade. So Alpha Tracker gives me that information. That's the upper study. If I zoom in here on the lower study, we can see a bit more information. And this is just that day, that Thursday trading day. We can see sellers in the Globex session. That's these red bars here, selling pressure marked by that. Again, a mild selling pressure marked by this bar here, and we're trading around here on the lows of the day so far. So very interesting that more sellers came in and sold on the lows. So a bit of a liquidation, not short covering, but actually adding to a short position. As we recover, we kind of consolidate around this Venom line on the market webs, we recover, and then it gets sold hard again. Buyers try to take it back, it doesn't happen. So we can kind of see the actions of big money here. And not only did sellers sell it at this defensive line up here, we can see them coming in and trouncing it again with 17,000 sell orders on this bar, taking it even lower. Once I see the buyers stepping in towards the end of the day, again, if I want to get out by the end of the day, well, I see the buyers stepping in once again on this low of the day. All right, time to take my short. Time to take my short off. I'll cover by buying. Okay, so the lower bars, the lower study allows me to see the offensive plays being done by big money, right? Very, very interesting. I love this new indicator. It's been amazing how perfect it is, and the calls that it has made and the defensive level that it's drawn, not only on futures but equities as well. Just really, really great. Okay, so moving on to crude, and I know I'm just blasting through here, so I will answer some questions at the end if I can get through this quick enough. Crude is much more of a news-driven instrument, okay? Supply and demand being the major driver. Every Tuesday afternoon at 4:35 p.m. Eastern, there's a preview of supply inventories with the API numbers. That's the American Petroleum Institute. This will tend to cause a movement in the Globex session before the 5:15 p.m. close. So there's about 45 minutes or so that you could capture a nice move in crude oil futures in the Globex session on Tuesday afternoons. This number is also a good predictor of the movement on Wednesday morning at 10:30 a.m. So at 10:30 a.m. is another, it's the EIA numbers come out, but they tend to be in the same direction and to remotely relatively the same magnitude as the API numbers the night before. So you can get an edge about knowing which direction the crude futures are likely to move at the 10:30 a.m. Eastern the next morning. So another opportunity there. A build in inventories is bearish, a drawdown is bullish in general. Once the news is out, however, this is very important. After Wednesday morning's EIA numbers come out, crude will be subject to more speculation about what inventory will be like next week. Therefore, the reaction to the news is typically brief and only continued if there's sentiment further in the same direction for next week's inventories. So a lot of people say, hey, those numbers came out and they were totally bullish. Why are we selling off? Because they expect next week to be bearish, okay? Once those numbers are out, it's all about next week, okay? That's the way crude moves, the way the cookie crumbles. Crude is also subject to the intraday margin benefit and therefore actually has two moments of covering that comes in. Because crude is of interest on a global scale, the European closing time of 11:30 a.m. Eastern is an important time for movement in crude futures. Here again, the European traders will be covering their positions. So in a down day, expect an up move at 11:30 a.m. Eastern and vice versa. Crude for American traders closes at 2:30 p.m. Eastern, not 4 o'clock, 2:30. So that's the other spot of covering. So again, if we're having a down day, there's going to be covering into 2:30 p.m. The move that happens at 11:30 a.m. is a good preview of the move that happens, that may likely happen at 2:30 p.m. Eastern. Okay, so very often, more often than not, look at what happened at 11:30 if you want to get a jump on what might happen at 2:30. Okay, so crude has all these really weird rules to it, but a lot of opportunities, a lot of quick scalp opportunities in it. Also look at what happens 30 minutes after the 11:30 a.m. close. This will give you a sense of what Americans are thinking about crude oil versus the Europeans and the rest of the world. So just a sense. It's not really tradable, but a sense anyway. Crude is good for trading on the Globex on Tuesday evenings and surrounding any major news events, so OPEC meetings, wars, disasters, etc. So if you find out that there's a big hurricane like Hurricane Sandy happening and the futures are open, crude oil is going to be something I'm looking at even more than the overall market, right? The indices. So again, I start off by looking at the larger view. Upper left corner, sorry, is the 1 hour bar. Those are the weekly webs. I can see that's very, very weak this week. I've also circled where the API number came out and where the EIA number came out. The API number, you can see, caused a downtrend, but not as big as the EIA number, okay? Also, we broke below value actually the week before, so weakness was really back then. On the weekly bars in the upper right corner here, we can see crude really couldn't get above this Venom line and we're selling off. So the market webs really give me great reference points, way better than, say, Fibonacci retracement lines or anything like that. The Venom lines here work extremely well, especially in crude. It's such a technical tool. On the daily bars, obviously weak, continuing lower, 47.97 is where we closed. So I'm looking for shorts only on a day trade. So if I look back and I'm looking at the alpha tracker on a 5-minute, I can see, okay, I only want to be short. So here on this day, and this would have been Thursday regular trading hours, they came in and bought it, 3,000 contracts. That's a big order for that time of the day. So I know that I want to close my short position. Remember, we've had a down day all day. Well, what are we going to do? Well, everybody's going to cover. So into the 2:30 close, everybody's covering. In the Globex session, we go up, et cetera, et cetera. And we start breaking below that level. And once we break below, well, that's a short signal, okay? So I could take it short here. I may or may not have gotten stopped out. Depends on if I took targets off the market webs or not. And we bounce and we stay below that line going forward. We can see lots of buyers in the Globex session. So everybody hoping and praying that crude will be speculated to the upside, and then during regular trading hours, some kind of news comes out, or for whatever reason, there are more sellers than buyers in the regular trading hours. And I can see all that now with Alpha Tracker. I'm no longer blind. I have an edge that no one else is seeing. So now let's talk about the Euro-dollar futures, and this is the third and last one. There's a lot of interest right now in the euro because of Greece is still in the headlines. Because of the attention it's receiving, I like to use it as my instrument for currency trading. The US dollar, that's the dollar index, /DX, is made up about 60% of the euro, letting the DX be a perfect inverse instrument to watch for trading the 6E. Other instruments to watch are the bonds, because as they rise, 6E will also rise. Also gold and crude. Gold even better, as gold rises, the euro will rise as well, because it means the dollar is weakening, okay? Because gold is a pair with the dollar. Especially in the current market, as we wait for the Fed to decide when rates will rise, when they will raise their rates, the data that comes out at the 8:30 a.m. timeframe, jobs numbers, GDP numbers, et cetera, like housing starts, all the kind of typical data you see in the morning, hasn't really been moving the markets much. What has been moving? Fixed income currencies, okay? These data events are driving the currencies and the bonds much more than the market. So the euro will react at these times very, very heavily, and that is also why all the fixed income instruments open regular trading hours at 8:20 a.m. Eastern, 10 minutes before this data comes out. That's why they open it up early, so that it can be traded. Okay, the market indices, they don't open until 9:30, right? So it's another reason why they don't move and react that much. But these, like the euro, the bonds, anything that's fixed income, including gold and the metals, they will all react much more. So I like using 6E around those times. Euro also tends to move the most of the three that we're talking here today in the Globex session, because it is tied to currencies. And we know that the Forex currency trading trades 24 hours a day. They're open even longer than the futures. So there's always movement in an underlying object or underlying currency that can cause the 6E or any of the currencies to actually move. I prefer the euro right now just because of Greece. It has a lot of attention, a lot of volume, a lot of liquidity. So again, we look at the larger time frames. Look at the strength here, actually. So this is a bit inverse, right? There's on the 1 hour bar, I can see strength where I'm pointing to where it's broken into value. It tried to break out of value and jumped right back into it. So that's a strong sentiment on the 1 hour bar on the weekly value areas. On the weekly bar, on the yearly value areas, it's a little more indecisive. It's weak, but it doesn't quite know what it wants to do. It's bouncing between these two venom lines. On the daily bar, it is totally strengthening, and it has been all week. So we just have to keep an eye on what's going on. And then on the 5 minute, I'm looking for longs only, because we're strengthening on the 1 hour bar, we're strengthening on the daily bar. I'm looking for longs. So I go in, I look on the 5 minute bar with Alpha Tracker, and I have a lot of information here. So on the Wednesday regular trading hours, I can see buyers coming in and defending the level around 109. We did trade below it, but then we broke out above it. It's a great spot to take a long. I'm looking for longs. This is a great spot to take a long entry with a stop just below that line after we've broken above it again, and then look for an exit. So on Thursday, so that's actually, I'm sorry, that was Wednesday's regular trading hour. On Thursday, look at these marks here by Alpha Tracker, seeing sellers coming in at these highs. Well, that's almost 100 ticks of profit. That's about $1,250 per contract in the euro. That's a pretty good profit. So maybe I want to get out of it. Could I have seen and gotten out at the highs? If I look at the lower study on the opening peak of the day, look what happened. A big red candle with a selling indication of 3,000 contracts. So somebody with a big order came in and sold on the highs. If I had been paying attention to the lower study, I could have even gotten out at 110.28 or 110.26 or 110.20 or whatever, and made even more off of the trade. Okay, so I like to keep an eye on both studies here all the time. You can see a lot of buyers in the Globex sessions on both days. That's good. Again, a lot of activity in the Globex session here, a lot of movement. You can see a lot of movement in the Globex here. We break below value. Okay. I'm still looking for longs. The problem is sellers really defended this level at 110. So if I've gotten in long in the Globex session right off of here, so buyers defending, so I looked for a long. This was at 3 a.m., so I probably didn't catch that one. I do like to catch some sleep at some point. But if I had gotten long there, I would have looked for this order that came in. Alpha Tracker said, hey, they've marked the top, get out here. and close my long position. So Alpha Tracker helping me there again. These are studies that I've created. Alpha Tracker is one of the most powerful studies I've ever come up with. I think it's the coolest thing ever. I love it. Anyway, so as a recap, trading futures can be very lucrative, and it's no harder than day trading equities or ETFs. The big clue is that each future has its own rules, not only in the tick values, but also in what is correlated with, specific moments and events that can affect it, etc. It's also important to remember that these three futures we've discussed, as well as others, also have options. This can give me protection if I need to stay in a position with a little extra margin requirement. A broker will recognize the protection. With little. It doesn't really add any margin requirement as long as I do it one-to-one. But it also means that around option expirations, this can cause some odd volatility just as easily as when the contracts roll. So I've talked in previous webinars about contract rolling with futures and stuff like that, and I'll talk about that at another time. But just something to keep an eye out. Futures or options expiration can be just as weird as triple witching. In general, keeping an eye on larger timeframes will tell me what direction I'm best to be playing for the day. Then using technical indicators, whatever kind you're comfortable with, will give you an edge while keeping an eye on the correlated instruments and knowing all about how each future contract operates, okay? For my trading plan, I use the market webs and I use Alpha Tracker solely for my technical futures trading. Both of these not only give me everything I need to know, but they give me a view on the market that I know most others are not looking at. And that's my edge. So we're all here today. We're all here to be sharing something. You guys are spending an entire day with us. I want to share with you a wonderful deal for Alpha Tracker. Okay, so this is what I'm offering here today is Alpha Tracker. You get a lower study where you track the actions of big money and all money and small money. It will show you on the bands, and I'll show you images of this in a second, how they are positioning themselves on the day. Okay, you can also use this for swing trading and see how they position themselves for a 20-day period. You can use it on equities and get suggestions about unusual option activity to follow. The upper study, as I've pointed out multiple times here, you can see where big money comes in and defends price levels. These create pivot points that no one else sees but have been working out brilliantly well. All the other moderators, Andrew, Christian, James, have all seen just how useful it is, and they're using it in their trading plan too now. It works for all equities, all futures, all ETFs. Bonus, we're doing 2 hours of live mentoring, 1 hour on August 1st and 1 on August 8th. So you still have time to get in. If you buy today, you will join me, be able to learn how I'm reading it, how I use it for earnings, how I use it for day trading, how I use it for swing trading, what I'm looking at with big money, small money. You know, even those other moderators are like, we can't wait till the mentoring sessions because we want to learn more about this indicator. So get it today, and you can join us for that, okay? Learn how to best trade around the actions of big money, how to analyze the data to decide for a swing short or a long, learn how to day trade futures, equities using the actions of big money. Today, the offer, $2.99. We have limited spots available for this. It's $2.99 today. It's http alphashark.com/alpha tracker. You can call the office 312-261-5581. But I really think you should check this out. It works for stocks, ETFs. It only works on Thinkorswim at the moment, not TradeStation. Hopefully we'll do TradeStation in the future, but at the moment it's Thinkorswim only. It's really brand new. We only released this about a week ago, but already people that have gotten it already have been amazed at how like accurate it is, and it tells them, you know, when to get into a position, but also should I stay in a position or should I get out of a position? It helps me with that as well. So I want to show what you'll get when you purchase this. Okay, so what do you get with the Alpha Tracker indicators? You get a lower study. It has two functions in one. The first function is the day trading. That's the one we've been looking at all day, okay? You can see where big money is buying all day. If you look at the blue line, as it climbs on a daily basis, big money's been buying all day. If it goes down, they've been selling all day. So we can see on the very first day, they sold all day. The next day, they bought all day. We can see the size of their orders, buy or sell. They're green for buys, red for sells. And you see if it's really significant, if they're stepping in large, it'll show you the size of those orders, right? The blue line represents big money's position. As it rises, they are buying. As it falls, they are selling. The yellow line you see here represents the all money. That's the nominal trades that are going on. The you, the me, the normal traders that are coming in with even with some size that are trading, right? They're not the big guys that are doing the big order all at once. It's kind of the nominal trade size. And then the red line are the really small high frequency traders, the scalpers, you and me trading little odd lots here and there just to take a little bit out of this here and there. That's the red line, and I can track them as well. So this allows me to really see more market internals on anything that I'm trading. We talked about market internals at the beginning of this. This is a new way to see market internals. The other format of it is the swing trading format. This allows me to see the same guys, how they're positioned cumulatively over a 20-day, 10-day, 5-day, etc. It tells me, it even gives me little labels to tell me, currently big money is 94% short on this, all money 89% short, small money 99% short. As the price, that's this gray line, is the price plot. As price is going up, everybody's selling it. Very, very interesting. So this works, and it also tells me unusual option activity to follow. It tells me if I see unusual option activity, like they're buying calls, do I want to join them on that, or do I think that's probably hedging? Okay, so it'll tell me if it's likely hedging or speculative. I want to follow the speculative. And then lastly, the third thing that you get with these studies is, again, those lines that appear on your charts. That's the upper study, where it marks the defensive selling levels, the defensive buying levels, giving me pivot points for reference to getting into trades and getting out of trades. And you can see this was Yum Brands. That's what we're looking at here. So not even a future, and look how well it's obeying as it bounces off of this red line here twice, 2 days in a row. And even bounced off the green line for a couple of days before earnings came out and it broke below. But this post earnings, that's where it stopped. Okay, so again, that's what you're going to get. Take advantage of this offer. I think it's, again, an amazing tool that I love using for my trades.
Hey, what's going on, guys?
I heard Andrew for a second.
Test. Hey, what's going on, guys? It's Andrew. I'm going to jump on here and just you guys go through the indicator. This indicator was just released by Webb. This is his third indicator we've now released. This is by far the best indicator I've ever seen anybody come up with. It is quite amazing. It is a one-time fee. You can sign up at alphashark.com/alpha tracker. Or call us at 312-261-5581. We're about 5 spots away from, I know, selling out of Christian's indicator. It is a one-time fee. Okay, so what we're offering today is Webb's Alpha Tracker Indicator. It's available. I just want to take the screen and show you guys one thing, which we flagged actually in the trading room the other week, and I don't even know if Webb was showing this example. Let me make myself presenter. I hear the phones ring off the hook. We have 50 spots available for this one. We will sell out at this price point. I know that. I see people saying it's too cheap, but let me just show my screen real quick because I wanted to show you this one. This is the S&P 500 futures, guys. I was talking about for a while how the market was a little toppy, and then I use the Alpha Tracker every single day in my trading. And we see this line here, which is a dark orange line. And is it a pure coincidence or not? And we talk about institutional order flow. Every presenter here talks about the same thing. It doesn't matter what you trade. You could be trading bottled water, houses, stocks, computers. Doesn't matter what you trade. It's just a supply-demand curve, right? I talk about like houses. The difference between what a house is worth and what someone's selling it for doesn't matter. It's fair market value. So Alpha Tracker flagged as short, and this was on the 24th, was it? Let me see the exact date of it. And an institution sold 21st. So an institution came in here and sold 1,400 S&P 500 futures. 1,400, okay? The minis are 5-to-1. So this trader sold about 6,000 minis, okay? Pure coincidence? This is the top of the stock market, okay? The futures have now been down 50 points since then. A trader and Alpha Tracker flagged this in real time. Okay, so Webb, if you want to take it back, I just put the link up. So what we're offering you guys today is a one-time payment of the Alpha Tracker indicator. We have 50 spots available. I see it is blowing up through my inbox here. I hear Justin on the phone in the background. You get the Alpha Tracker indicator for Thinkorswim. There's no money back guarantee. It is a one-time fee. You pay $2.99, you own it for life. If you trade for the next 3 years, basically breaks down to about $100 a year, which is about $8 a month, which is about 20 cents a day. Okay, so it's a one-time fee. It's available on Thinkorswim. Okay, you are including 2 hours of private mentoring. 2 hours of private mentoring. Webb takes time. Webb started on my team about 1.5 years ago, and to be honest, I think he's probably a better presenter in webinars than me because he goes a lot slower and he is in theater for so long. I go very, very fast. I know Foster is a trader and he goes pretty fast too. Webb tries to slow it down, and we're giving you 2 hours of mentoring for free, okay, included in the price point, a one-time payment of $2.99. We have 50 spots available. I know there's about 4 spots available for Christian's indicator we still have available, and this is Webb's third indicator. Usually we come out with a new indicator with Webb every other month, and Webb said, I have something I'm working on. It's going to be so big. I want to take 3 months to do it. And I said, Webb, knock your socks off. So he took 3 months to do it. It's a $2,100 value. So it's a $2,097 value, and we're offering it to you guys for $2.99 for you guys coming, taking your time, and listening to the presentation. I appreciate it. Michael, you're in. I'm getting my emails here. Doug, you're in. Jack, you're in. Betsy, you're in. Edward, you're in. Steve, you're in. Sean, you're in. Make sure you guys take advantage of that. Also, any upgrades. Okay, so let me just say 4 things. I'll give Webb about 7 minutes to go through examples. Number 1, $2.99 is a one-time fee. It's available for Thinkorswim. If it ever gets available on TradeStation, we'll give that for free. Number 2, there's no money-back guarantee because this indicator is so good. When you own it, you get it for life. Number 3, we're going to throw in 2 private group mentoring sessions, August 1st, August 8th. Those are an $800 value alone. Webb is going to go through examples for you guys during those times, and those will be recorded and sent out. And number 3, 70% off today and today only. We're going to sell out of it. We have 50 spots available. That is it. After those 50 spots, you can go on the website and buy it for $9.99. And number 4, it is available. Any updates will be included for free. So if Webb personally doesn't like anything, he'll update it for free. And also, it works for every product possible. Okay, I know a lot of the stuff I trade is unusual option activity, which is options only. This works for options, stocks, futures, forex. It doesn't work for forex, sorry. Futures and stock. So it works for everything except for forex. We flagged a short on the S&P 500 futures on the absolute high of the last 3 months because a institution came in and sold 1,381 futures at that price point. So Webb, feel free to go through examples. You got about 6 minutes here. Edith, you're in. Chris, you're in. Make sure you guys take advantage. This is the best indicator I've ever personally seen. Okay, this is the best. Make sure you leave the link up there. This is the best. We have 4 indicators. This is the best indicator I've ever seen. So Webb, go ahead, take about 5 minutes, then I'm going to have to give it to the next person.
Sure, absolutely. Thank you.
Go fast.
Someone wants to look at COF. Okay. Yeah, we'll just kind of go through this a little bit. So we can see in COF, sellers actually coming in. So it was slammed down on earnings as it's hard to see because everything's so compressed up here, but what you can see is that on earnings, there was actually a buy line that was defended just before that earnings came out, and then we traded below it, so that marked the high, and then sellers actually came in and trounced it a bit further even after the day. So, oof, that one did not work out so hot. SWKS, Skyworks. Look for Skyworks. You can see a big sell order on the close of Friday. About 250,000 shares sold on Friday. Earnings came out. Let's see. Can we see anything pre-earnings? Some selling early in the morning. Big buy order later. Some buying going on, but overall, big money was short going into earnings, and that's probably why it continued down the next day. Of course, the overall market was not so hot. Did see some buying later on in the day. I'm just going to pick a couple here just at random. A lot of people have a lot in here that they want to look at. Priceline is another one where we broke below this defensive buy line and we're trading below it. and just seems to get hammered a bit more. The only big money order was this big sale of 20,000 contracts around 12 noon. And how does it look for SLB? Someone asked something about there's going to be updates to how orders are tracked or whatever. I'll tell you, I use this for my own trading, right? So if you get this too, as Andrew said, you're going to get updates with it. SLB, by the way, breaking below this selling defensive line, and we continue lower. There are some buying coming in, but look at the size of the selling orders, much, much larger. So SLB would have been a great day trade to the short side. I can use it just like I would day trade the futures, but I can just use it on equities, trading options or whatever. So anyway, what I was saying is I use this for my own trading. It is hands down this in the market webs. That's what I use for my trading. So if an update comes out or the exchanges change something that makes them no longer work, you better believe I'm going to fix it, right? And then once I fix it, you're going to get the updates too. So you buy this, you're going to get updates for life. People are asking about migration to TradeStation. It's in the ether as wanting to do it. I just need time to go ahead and do it. If you purchase the indicator, you can go ahead and when it comes out for TradeStation, you'll get that update as well. I just want to point out though that you can get Thinkorswim for free for 60 days with no account at all. You can also open an account and never fund it, and you get Thinkorswim for free as well. So there's not a huge barrier to just getting these indicators and using them on Thinkorswim. So that's another reason why I do focus all my attention on developing for Thinkorswim. There's no money back guarantee on this. Once you buy it, you have it for life. But I promise, I mean, for me, I've ever since creating it have made much more than the cost of that indicator. As Andrew was noting, there are plenty of people who have bought it already and been using it all week this week and said we're selling it for far too cheap. They say that about the market webs as well. Amazon, I had a butterfly that I was managing all day on Amazon, and what I could see was early on in the day we saw a lot of buying, of course, overnight from the earnings, but no big money coming in and buying it or selling it, right? And then right on the open, a huge sell-off by normal money. No big money, but normal money. Big money stepped in, did some mild buying, followed by some mild selling, so they're not sure where it's going to go. They did a big buy here, which led to the uptick, right? And then started selling it hard. So I knew we were heading down, and we had a really big sell, 140,000 shares right here around 2 o'clock, and we headed lower and we closed on the lows of the day. It reminds me, I want to bring up and show you FCX, which on Thursday had a big sell-off, and this was pointed out to me by one of our other moderators, James Vermelli, who had a position on an FCX, and he said, look what Alpha Tracker did. Alpha Tracker actually flagged on this bar here. I'm going to point out right there. I'm not going to bother getting my drawing tool. That bar, they sold 1.7 million shares of FCX. 10 minutes later, look at the sell-off in FCX, about $1 point down. So I would have had 10 minutes of warning to get into this short. So
All
I just
right,
want
guys,
to point that out.
is it. We're going to wrap it up here. If you can just move your Thinkorswim, I'll go through one more time what we're offering today, and then we'll go to our next presenter. You can get the Alpha Shark indicator. It is available on Thinkorswim. It is a $2,097 value. We're offering it to you guys for $299. If you cannot get available on the phone, keep calling. We have 2 lines going. That just means people are on the phone. We're offering it for $299. It's alphashark.com/alpha tracker. It gets an indicator for life. You own that indicator for perpetuity. Also, the 2 private mentoring sessions, Webb will go over any charts he wants. I just downloaded it and paid for it myself about 2 weeks ago. It is one of the best day trading things I've ever seen. It's probably the best indicator I've ever seen because it's exactly like trading unusual option activity. It shows you where big money and big order flow is going. So make sure you guys take advantage of the promotion in my inbox. This is my inbox where I get these emails. This is people buying them. Peter, you're in. William, you're in. Make sure you guys take advantage of the promotion. We probably have about 30 spots left. We will probably sell out today. alphashark.com/alpha tracker or call us at 312-261-5581. I know, Webb, if it was your choice, you would sit around and talk for the next 2 hours and help everybody. Thank you, guys. Thank you, Webb. I'll talk to you later. And let me bring on the next presenter while I finish the recording. And make organizer. a web webinar.
Hey Andrew, how are you?
Good, how are you?
I'm good. How's the weather in California?
It's always sunny in San Diego.
Yeah, it is always sunny in San Diego. Unlike
Uh,
Chicago where it's rainy a lot. So you've not missed much of a summer, I'll tell you that much. I'm sure your boys have told you that.
okay, you have the screen.
Appreciate it. All right. So I'm ready. Should
Okay,
I
let me
begin?
start the recording, and then I'll give you an introduction, and then I'll be all yours.
Awesome. Thanks, Andrew.
All right, guys, our next presenter is Mark Sebastian from Option Pit. Actually, a fellow floor CBOE trader. Me and Mark go way back. I started on the floor in '01. I started clerking, so I started trading in '02. I think Mark might have been down there a little bit before me. Mark Sebastian is a former member of the Chicago Board Options Exchange and the American Stock Exchange. He is the managing partner of Option Pit. Mark Sebastian is CIO of Carmen, did I say that right? Carmen Line Capital, and the author of Trading Manual, The Option Trader's Hedge Fund, which I do have an autographed copy of. He is a frequent member. I'm sure you've seen him on CNBC, Fox Business, Bloomberg, CBOE TV. Sebastian has been published nationally in Yahoo Finance, quoted in the Wall Street Journal, Reuters, and Bloomberg, is an all-star contributor for the Streets Options Profit. Mark has spoken with OIC Options Industry Council, the CBOE, the ICE, the CME, and is a co-host of the Option Block and Volatility Views podcast. He also has a Bachelor of Science degree in Finance from Villanova. Out of everybody presenting today, I actually know Mark the longest because we were floor traders on the trading floor at the Chicago Board Options Exchange. I think I found out there's 2 independent equity option traders left on the floor, not including the VIX and the S&P. So we stayed down there as long as we could, and juiced it and milked it, and everything we learned from the trading floors, we moved upstairs, I call it, just, we left the trading floor, and we teach it to you guys. Me and Mark have very similar backgrounds, and we think very similarly because we were market makers for so long. Not many people can say they were market makers on the floor, but we were 2 of the ones that teach, educate, and trade on our own and try to provide that for you. So this presentation is going to be really good. Kick back, relax, enjoy it, and I will be back in towards then. It's all yours, Mark.
Hey, thanks, Andrew, and appreciate the introduction. Yeah, one of the things I always tell people is, Andrew and I, we're friendly competitors sometimes, but, I think we understand each other in that we're 2 of the guys in our business that are teachers, but we also actually trade. We haven't just completely given it up to try and huck education, which I think really differentiates the 2 of us. And, that's one of the fun things, and I'm excited to be here. So today we're going to talk about weekly options. Again, my name is Mark Sebastian. That's me talking to my girl Liz Klayman on Fox. You can see I'm 5'0", 100 nothing, but I was a floor trader for about 10 years. I actually, Andrew and I started at the same time, but I started on the American Stock Exchange and then moved over to the CBOE. So I started out in New York, then moved to Chicago, and I'm from Chicago, but just started out there. And from there, I founded Option Pit. We do education and consulting. So I work with retail clients, kind of teaching them a professional approach to retail trading. And then on the institutional level, I'll go into a asset management group or a hedge fund or a money manager, and I'll help them implement option strategies. I'll do stress testing of option strategies, and I'll do quality control of option strategies. So I joke that I've dealt with clients with $1,500 and $15 billion, and the scary thing is the guy with $1,500 usually knows more about options than the guy with $15 billion. It's a little scary that it works that way, but especially in the money management space. The hedge fund space, they're a little further ahead, but not so much asset management, money management. So here's what we're going to learn today is how option time value decays, how the pricing model breaks, the advantages of using weekly options, the disadvantages of weekly options. I'm going to talk about some strategic uses. I'm going to talk about the basic use of weeklies in directional trading, and I'm going to give you a quick example of something we've traded option pit. and then I'm going to talk briefly about the VIX futures that just listed last week, the VIX weekly futures. All right, so decay. All right, options are just another form of insurance. As time passes, insurance policies lose value. Even on the last week, though, an insurance policy will still have a ton of theoretical value. So, if you switch insurance companies midstream, or even the week before your policy is about to lapse, there's still some value left in that policy, right? Much like insurance policies, options decay with the passage of time. Up to the last second, an at-the-money option will have insurance value. All right, back in the day when we had a greater pin risk, if an option settled within a quarter, or if an underlying settled within a quarter of an option, that option would go out 10 cents. Now that it's only about a penny before an automatic exercise, and if it's anywhere within a couple of cents, the call or put will have at least a nickel and usually a dime of value left at expiration. So this is the chart that we're all kind of used to seeing for at-the-money options. Now you see how the last 30 days it starts to really exponentially lose value, and then the last week it loses even more value. All right, and this is the chart that every person looks at and goes, well, this is why I sell options. Okay, but it's not that simple, and we're going to talk about it a little bit. So at-the-money option premiums decay exponentially. It gets faster and faster and faster. And that is really one of the real values of the weekly options. So the weekly options, one gets short at the really exponential point in the curve. All right. In theory, one should be able to harness lots of premium just slamming weekly options all the time. Selling weekly options against portfolio stocks, selling weekly options in spreads, you name it. Theoretically, selling at-the-money weekly options is going to harness a ton of decay. But is that really how decay works? All right, is decay that easy across the board? And the thing to remember is this chart, and you've heard me say it a couple of times, this chart really only represents at-the-money options. A lot of people think this chart applies to all option strikes. That is incorrect. This is not for all options, just for at the money. So let's take a look at kind of how decay is different. All right. So you see how at the money and out of the money decay differently. Out of the money options have less premium. And what do you notice about the curve of the out of the money option relative to the at the money? It's far more linear is the key. So the thing to understand is that with time, the more time and the more out of the money, the more linear the decay. Okay, so my friend Jim Bittman, I think Andrew knows Jim as well. He in his book talks about decay, and one of the things that he studied in depth and in detail over hundreds of stocks is the decay of options that are 10% out of the money. Options that are 10% out of the money actually will lose more value from day 60 to day 30 than from day 30 to day 0. So let me repeat that. Options that are 10% out of the money will lose value, will lose more premium from day 60 to day 30 than from day 30 to day 0. And understanding that is going to really change and help the way you trade options as a whole, and especially weeklies. So let's talk a little bit about decay a little bit more. All right, so we've just established that the further out of the money you go, the more linear the decay is. All right, and at the money decay is exponential. All right, so we now have 2 main points. We're going to hit our third now. All right, we're going to hit all of the major points of decay. All right, so if one were given a chance, and this is a question for all of you, if I were to give you a chance to flip a coin, all right, and if it lands on heads, you get $1 million, and if it lands on tails, you owe me $700,000. Would you do that coin flip game with me? How many of you would flip a coin once for the chance to win $1 million or pay $700,000? All right. Now, now you only get to do it once. You only get to do it once. You do not get to play again. All right. Yeah, I'm seeing a few people saying yes, and the answer is no. All right. And the thing is, it does have a positive theoretical value. It does. All right. It has a positive theoretical value. Right. It's a 50-50 coin flip that pays out about 1.5 to 1. All right. However, so it has a positive expectancy. However, the risk associated with being wrong is catastrophic to a lot of people. All right. Now, Donald Trump will play this game. All right. You know, Ken Griffin will play this game. But people like most of us won't, because the odds of losing $700,000 are too high. All right. So for most people, the answer is no. All right. Now, what if you got to execute that coin flip 50 times before the slides paid out? And the answer is yes. Yeah, you would do it then. All right. So this applies to what we call teeny options. All right. Do you guys know what a teeny option is? All right. So back when Andrew and I first started trading, when we were training, they quoted options in fractions. No, they quoted options in fractions. So the tiniest dollar value an option could trade was 1/16 of a dollar. All right. So yeah. So what's a dollar divided by 16? 6.25 cents. All right. So the cheapest an option could trade was 6.25 cents, and they were called teenies. All right. So, and the idea was, you know, you'd have everything, all these way out of the money options quoted as teenies. All right. And the one thing that, and there were definitely people that went out selling teenies. All right. But the problem is both at the money and out of the money options can decay to the point where they start to act like our coin flip game. All right. Where, yeah, the odds of selling those teenies are great, but when you're wrong, it represents kind of a catastrophic loss. All right. And there's multiple reasons, but so while the sale of a nickel option, or you know, in this case, the old 6.25 cent options has edge to it, while it's probably a worthless option. All right. Because of the risk associated with being short teenies and the margin associated with those. All right. So even if I'm short a nickel option that has no chance of being placed in the money, every single option chart causes the market $25 in what we call margin haircut. All right, which uses up capital, it soaks up capital. So if I'm short 100 worthless options, it costs me $2,500. So that margin gets eaten up fast. So because of the risk associated with being short a worthless option that ends up being worth hundreds and hundreds and hundreds of dollars, and the margin associated with that, which is, you know, $25 an option, decay kind of stops once an option gets cheap enough. So really, this is what I think represents true option decay over the life of an option. All right. At a certain point, it slows down. And really, up to the last minute will be kind of worthless, or will have some value. All right. This is kind of this is kind of just out of the money, we'll say, and this really represents any option. All right, is that, and the point I want you to pay attention to is this part right here. Once it gets cheap enough, it stops decaying. All right. So, you know, people want to say, okay, when is an option at its fastest point of decay? That's probably a question you're asking yourself. And what I call it is what I call the, you know, the time to think about it is what I call the cone of feasibility. All right, the cone of feasibility. Now, what is the cone of feasibility? The cone of feasibility is when an option goes from that could happen to that probably won't happen. That is when it decays at its fastest level. So, like, you know, let's pick a stock other than Apple to talk about. Somebody throw out a stock. All right. Let's do. All right, we've seen Google a couple times. Let's say Google. All right. Google is. All right, we can stop. We'll use Google. All right. Google's trading what? Let me check here. Google is trading. We're going to use the. So Google is trading $654.77. Okay. So do we think that Google will be trading $750 by expiration next Friday? All right. Now, do we think Google will be trading $750 by August expiration? Probably not, right? All right. What about January expiration? January expiration, possibly, right? So somewhere, you know, so now, all right, so now, what about December? What about October? Okay, October. That's got an earnings. There's all sorts of different things. October or November. So right around October, November timeframe, all right, if I look, right about now, the October 750 call is probably in the area where it's experiencing its most decay. All right. Yeah, well, I'm not doing anything to the screen right now. That's why. So right around now, October is probably experiencing a lot of decay. So how is this all related? Well, let's circle back to what we just learned and discussed, where the edge is in weekly options. All right. So what we know now is the last week of a weekly options life, decay is huge, right? So decay is fast at the money. All right. We now know that out of the money options decay linearly, making this week and last week a lot more similar. Thus, there's a much smaller edge in selling out of the money weekly options relative to at the money. And then finally, we know that nickel options don't really decay very much. All right, and let's look at these in a real fashion. So this is from April and May. All right, so this is GM, and what I want you to notice is, so the April 10 calls have 2 days to expiration, and they have a 29-cent theoretical value. All right, the May calls have 22 days to expiration, and they're worth 95 cents. Well, let's do the math. All right, how many times does 2 go into 22? And if you can't answer this, you should stop trading. Right. So it goes in 11 times. So what is 29 cents times 11? Yeah, $3.19.
All right. So if I got to do this trade 11 times, it doesn't really work that way. But in theory, this has 3 times the decay. And, you know, that's kind of the key, all right, is understanding that at the money piece. Now, let's look at immediate out of the money options, all right? So now we're looking at the 37 calls. So the 37 calls, all right, 9 days to expire are worth 14 cents. The 37 calls with 22 days to expire are worth 51 cents. All right, so let's do the math now. And you guys, so how many times does 9 go into 22? This one's a little harder. A little less than 2.5 times. All right, so what's 14 times 2.5? About 35 cents. Right. It's about 35 cents. So in that GM 37 call, all right, I can get 14 cents with 9 days, or I can get 51 cents with 22 days. So how many of you were expecting that result? You actually get more decay selling the further out option. So believe it or not, the 37 call is going to make you more money selling it than the April. This generally catches a lot of people by surprise because they're taught that the weeklies have so much decay. And now finally, let's look at teenies. And you know, these options have 2 days to expire, and we talked about the fact that GM is you know, none of this involves commissions. I can promise you, my option theoretical pricing model never took commissions into account. All right, so the bid-ask spread and commission stuff, that's not the point. All right, and none of that has anything to do with theoretical value or decay. All right, and quite frankly, $3.19 of decay in 2 days versus 95 cents over a month, all the commission in the world, you won't pay that. You won't make more. So, but the point, now look at these teeny options. So these have 2 days to expire. The 37s and 35s are way out of the money, and they're still worth 3 cents. So think about this. The 37 call with 9 days to expire from our previous slide is worth 14 cents. This one has 2 days to expire, and it's still worth 3 cents. All right, so that out of the money option, that far out of the money kind of worthless option, it can take forever to decay. All right, up to the last minute. All right, so the point is, these never, you, by sitting short, trying to collect premium on these little options, all right, you are throwing money, you're wasting your time and probably throwing money out of the table. All right, and you're using up a bunch of capital. So now the lesson. Weeklies are for near the money option. That's where the edge is. All right. If you are selling out of the money options, you are giving away money and should be in the back months. All right. And teenies will take forever to decay. If you are a roller, so if you are a person that consistently rolls options back to collect premium. Once that option becomes worth less than a nickel, close it and move on. You will make more money just doing that. All right. So this right here, if all you do is start doing is this, you will make more money as a premium seller. All right. It is worth the commission to close. It's like Alec Baldwin used to say, right? What did Alec Baldwin used to say? A, B, C. We know what that stands for? What does ABC stand for? My wife knows. Sweaty balls. Always be closing. Right. There you have it. All right, so weeklies versus monthly. All right. All right. Should one always sell weekly options? One is trading near the money. What about covered calls and cash secured puts? There is a trade-off. All right. In return for the extra premium, the trader is taking on more price movement exposure. This is called gamma. All right. Thus, if all goes right, a trader will make more money selling 4 at-the-money covered calls than 1 monthly. However, what if the underlying really starts to move? All right. What if you're in an option that in a stock that starts really whipping around? Well, then the monthly may make actually a lot more sense. All right. So the monthly will have more raw premium. All right, which means you'll get more dollars at once. Now, the weeklies will be less premium, but added together, they add up to more. All right. It's like if you sell a monthly, you'll collect $2.50, and the 4 weeklies might be 80 cents a pop. So if one is, the monthlies will let you wait out a pop if you're doing covered calls. All right. So if you're not an active trader, right, the weekly option just expires and may take away one stock if it is not bought back. Or worse, you cover and the stock drops. All right. So generally, I think weeklies are for more seasoned traders. And that's because gamma, which is exposure to realized volatility, exacerbates the need to close worthless options. All right. Indeed, close worthless options. You will make more money. Now, generally speaking, there is edge in selling just out of the money options or at the money options in the weeklies and hedging them with further out of the money options. All right. So those of you that are quote unquote credit spread traders, the edge in weekly options is selling them almost at the money. It is not in selling them out of the money. All right. We just showed that. All right. Because of the hyper decay of near the money options and the linear decay of out of the money options, credit spreads can make a lot of money quickly. All right. Options that need to be sold should have some teeth. Don't sell hyper things. All right. I don't like doing weeklies in crazy names for premium harvesting. All right. So by that I mean trying to produce theta, produce income by selling options. You don't want to do that in crazy stocks. You want to do them in stocks that have some teeth but aren't completely nutbags. So let's take a look at a trade here in IBM. All right, IBM closed a little under 160. All right, and here's what I mean by that value. All right, I want us to compare the weekly 160.65 call spread versus the monthly 160.65 call spread. So the July 31s have what amounts to 5 trading days to expire, and the Aug 21s have what amounts to 20 days. All right, and what do I collect in the 2 spreads? All right, in my Aug 160.65 call spread, I have it worth, let's see, 80 and 235. So I'm collecting about $1.55. Right? So this guy, about $1.55. All right? Now what about my July my July next week, right? The 60-65 call spread, right? Well, this guy's worth about $1.35. The 160 calls are worth about $1.35. We could say $1.33. And my 165 calls are about 18 cents. So we'll call that $1.15. So would I rather sell a credit spread with 5 days to expire at $1.15, or a credit spread with 20 days to expire at $1.55? There are certainly risks associated with both. Yeah, but the $1.15 has a lot more edge to it. A lot more edge. All right, and that's because you're getting this option that's going to take forever to decay on the cheap, and you're selling this one right at this guy right before it starts to really tank in value. Any questions so far? This is a good point to stop before I move on. Who's to say it will tank? No, the premium itself will tank, all other things being equal. What about selling weekly and buying the monthly? That's called a calendar spread, and we're going to talk about those. The long strike is in green. Here, let me clean this up. So the long strikes are in green. That's the 165s. The short strike is in red. That's the 160s. No, it doesn't matter if it's put or a call. So if you wanted to do the 157.5, 152.5, you would still be doing better off selling the weekly option. Call or put does not matter. What's the definition of near the money? Typically anywhere inside of between about a 38 and a 62 delta. All right. So yeah, well, no, about less than that. All right, a 38 and between 38 and 62 deltas is far less than a standard deviation. So that amounts to about a little less than half a standard deviation. All right, so let's move on from there. What platform are you showing? It's called LiveVol. Yeah, it's somewhere around about a half a standard deviation. So the platform I'm using is called LiveVol Securities. Half a standard deviation. All right. All right. So the real edge in weekly options is strategic placement of an option trade. All right. I think so. This is where the real edge is strategic placement. All right. One can pinpoint where one wants to take long risk and where one wants to take short risk. One can pinpoint and even analyze event risk. So here's where I use one way to use the weeklies is for information. All right, so Bed Bath & Beyond, otherwise known as Bloodbath & Beyond, as I used to call it, all right, the value of the weeklies is a good way of determining how much the underlying might move. All right, so this is right before earnings, and you can see that the theoretical value of this straddle with Best Buy or with Bloodbath trading 77.68, the market is expecting about a $4.20 move, or about 5.5%. All right, so there you have it. I mean, the nice thing about weekly options is we can quickly analyze the earnings. In this case, about a $4.20 move out of Bloodbath. All right, so now here's where I use it, is in strategic placement. All right, so there's this company called Tesla that I'm sure none of you have heard of. All right, and I know they have earnings on the 5th, but I can see when their earnings are simply by looking at the implied volatility. All right, you notice how it goes from 36 vol to about 63. All right. So one way that I will use, all right, I personally almost never play earnings. All right, I think it's a losing proposition. If you're it's such kind of a crapshoot, and certainly anybody that thinks there's edge in like selling options around earnings, I think you've had your lesson learned between Google, Netflix, Apple, and Amazon. And Facebook's probably going to teach you another lesson if you try and sell. All right, but just by looking at these IVs, I can see when the earnings week is. So if I want to play in Tesla, all right, I want to use earnings to my advantage. So this was the trade that I did. I like to fade these things using calendars. All right, so Tesla, after tanking, has had a nice recovery. I thought it was going to drop more. All right, and this I actually wrote up this trade last Friday. And so a week ago Friday, all right? So the stock has moved up and down some, and I want to fade the move, all right? I can use strategic weekly calendars to place a bearish trade while reducing my risk associated with that bearish trade. So what I'll do is I'll buy the announcement weekly put, slightly out of the money. So I'll buy the earnings week, and I'll sell a near-term put that is just out of the money as well. Thus, I'm harnessing that weekly decay. I'm strategically buying a firm weekly. All right? One of the advantages of owning an earnings weekly is that they never decay. They will just sit there and last and last and last. They're like big red freshness. They last that long. All right, that is how long they are. All right, you buy an option in a weekly contract that has earnings. It's like that. The decay is kind of like that couple making out as the boat is leaving. All right, in the big red commercial, it's that bad. All right, so what I'll do is I'll strategically buy that firm weekly, and I'll end up getting short deltas, and I end up with a cheap put that I can turn into a new calendar or a new diagonal, or I can just close. So let's just look at the trade. So this was last Friday's close. It was the July 24s against the August 7s. And you can see it was a $6 trade. All right, and you can see here's where Tesla settled. And here's where it is now. So not a huge, it's not like Tesla's down a lot. And now you can see that that weekly went out worthless. I would have closed this for a nickel. I used this trade as an example. I did not execute this trade. Let me be clear. I did do something similar in another name, not this one. I can't trade Tesla, to be honest, because I dislike the company so much. I can't have a fair opinion on its value or its volatility or where it's going. I'm too bearish. And I know your weaknesses, folks. But you can see how this thing kind of played out, right? Tesla really hasn't moved that much. The volatility has gone way up, and that out of the money put is worthless. And this is kind of how the payoff diagram worked. So other uses for weekly options, all right? I can use them for the wheel. I can use them for butterflies. I can use them for standard calendars and double calendars and directional calendars. They are terrible for condors and strangles because the decay doesn't slow down. All right? All right, now finally, let's talk about the new VIX weeklies. All right? So you can see the VIX now has 2 weeklies The put spread was the July 24 expired yesterday versus the August 7 260. All right. Actually, I actually now have like a little butterfly that I'm going to close. Bear butterfly. I shouldn't have traded it. I should know better. And what you can see is we now have these weekly VIX options. I thought the stock was going to drop. What was the question is, what was the reason for using puts? I thought the stock was going to drop. It was a way of using a directional opinion and using the earnings to kind of prop up my short put or my long put, retain value. So you can see we now have weekly VIX options that are in the front, the weeks in between the front month future and the next expiration. So we've got a VIX weekly that is going to expire next Wednesday. That's going to expire August the 31st week. All right, so it's going to expire on, I believe, the 5th. And then we're going to have one that expires on the 12th. And then we have the regular August that expires on the 19th. They're then going to list one that expires on the 26th next week. All right, so they're going to be carrying at least 2, typically 3 of these around the regular earnings contract. So there'll be 2 in front, 1 behind. The plan is for them to bring options on in VIX. And I'll tell you something about VIX options. Options in general overpriced. You got to be smart about how you trade them, but VIX options are even more overpriced than regular options. But it's also dangerous because VIX can explode. And so, what I've seen is these are going to trade. All right, so what I would encourage you guys to do, all right, especially since it's just futures now, they haven't added the options yet. Start watching how closely the front 2 contracts track cash VIX. All right, so keep an eye on how the 2 correlate. All right, so a VIX future with about 30 days to expire is going to correlate at about 50.5 to, so it'll have about a 50 beta to VIX itself. These front months are going to be a lot more sensitive. So if you're looking to actually trade VIX, you still can't. But these weeklies are going to get extremely close to being a actual play on VIX. So just be aware of that. So in summary, decay is more nuanced than people realize. Weeklies can be good for credit and debit spreads. Weekly value is in strategic placement. And weeklies are great to finance directional opinions. So what's my offer? I've got this course. It's a 45-minute course. It's $12. All right. And we'd normally sell it at $197, $197. Today, $12. Now, why $12? Because I think you're going to like it, and then you will buy something else from me. It's what we in the business might call a loss leader. You go to optionpit.com/option income. So optionpit.com/option income, and you can buy it for $12. And think about what costs $12. That's what Starbucks for 2. All right, and maybe it's I take my kid for a Happy Meal and I eat a Big Mac and a Coke, and that's $12. So I think you'll find value in this, and if you learn some things here, this will pick up from there. All right, so here's the link. There's the link. All right, optionpit.com/option income. How long is that? It's about 45 minutes. So, it's worth the time though. You'll like it. Oh, good. All right. Any questions? I gotta drive my wife to Wrigley Field after this. Yeah, you might be crashing it. That's possible. Yeah, if you can't get it open, it is not live. It is a recording.
Test. Yeah, so Mark just put the link up. It's optionpit.com/option/income. I put the link in here for everybody. Check it out. It's really good value. It's usually $197. It's only $12. So how long is the course, Mark?
About 45 minutes.
45 minutes, and then once they purchase it once, it's just one-time payment, right? And they'll never be charged again.
Theirs forever.
Theirs forever.
There's no reoccurring billing. There's no nothing. Just $12. And if it sucks, you never have to deal with me again.
Well, I don't think it will suck.
Well, thank you, Andrew. I don't think it'll suck either.
So if you guys are interested, I put the link in here. It is $12. That's it. It's a one-time payment, so once you pay for it, you will own it for perpetuity. It's 45 minutes long. It's going to be, help you if you liked Mark's presentation today about credit spreads versus debit spreads, when to buy and sell the right strikes to minimize profits and maximize profits and minimize risk. Hello, maximize profit and minimize risk. Make sure you guys sign up optionpit.com/option/income. It is on demand. So once you pay for it, it is yours. You can start watching it at the end of my presentation or right now if you even want it. 45 minutes long. It'll really help you guys hopefully with weekly options. I was just talking to someone on the phone and they're like, everybody in this world is always going to trade differently. I'm going to trade differently than Mark, differently than Fausto, differently than Christian, different than Webb. Just decide what is your trading style. There's some people that love trading weekly options. Some people, this guy on the phone just goes, I'm a weekly option junkie. Well, if you like to trade weekly options, this is probably a really good course for you. There's some people that only trade Forex. Okay, unusual option activity per se does not work for Forex, so that is something that will not work. So just decide what works for you. Take it, one-time payment, $12. I just sent my Justin out to get acai bowls. I know that's going to be about $24. So for half the price, you get a nice course that you can watch today or tomorrow.
Great.
So make sure you guys take advantage of this promotion. It's optionpit.com/options. I don't know if that's called a dash-income. I'm putting the link in here. Does anybody have any questions for Mark? Otherwise, he said he has to take his wife to Wrigley Field. Who are they playing today?
Strategies for avoiding assignment. Yeah. If your calls, if you've got an upcoming dividend and you're shorting an in-money call, close it. If your put gets too far in the money, close it. That's really about the only thing you can do. Good question, though.
Anybody have any other questions for Mark? Otherwise, we'll let him go. Who do the Cubs play today?
I'll run Lauren out to Wrigley Field.
Who do they play?
They're playing the Phillies.
Are you going or you're just chaperoning?
I'm dropping her off, and then I'm taking my kids somewhere. She let me go to the game by myself yesterday. It was very nice of her.
Did they win yesterday? The Cubs are pretty good, right?
Lost.
Like 8 over 500.
Yeah, they're doing really good.
Yeah,
I went to Villanova, so I don't dislike Philadelphia. Other sports fans are insufferable.
Do you know that they have the statistic in each individual sport, the franchise with the most losses, the Phillies are it for baseball.
Oh wow, great.
The Phillies have the most losses for the franchise in history. The Blackhawks actually have it for hockey. How amazing is that?
Oh wow, I didn't know that.
Well, it's got to be one of those teams that's like the original 7, right, or something like that.
Yeah, they are original 6.
Original 6.
Well, Andrew, thank you so much for having me, and I appreciate you bringing me on as your guest, and I really appreciate everybody listening to me yammer on. I hope everybody has a great day, and you too, Andrew. Enjoy that great weather.
All right, thanks, Mark. Yeah, so you guys want to take advantage of the promotion. This is the lowest price offer we've had today. $12, 45 minutes recording. You have that on demand for perpetuity. What you will learn in the course is mastering buying versus selling trading decisions, execute credit versus debit spreads, extract more dollars from the market on every trade, pick the right strikes to buy and sell the right strikes. Is always finding the strikes is always an important one. Out of the money, are going to give you the best ROI, but you need that FAR, fast, aggressive, move in the right direction. How to maximize profit and minimize risk. It's available for the first 200 traders. Mark says, learn to become a hunter, not the hunted. I always say I'm a hunter. I only eat what I kill. So make sure the link is working. Let me just double check in my own thing here. It's optionpit.com. There might be... Hopefully we didn't crash the site with too many buy links. It works? It does work. So here it is. All right, guys, we have a couple minutes here before our next presenter here, so maybe go get some water, grab a drink. We'll start here in about 4 minutes. Let me just put on the schedule of what's going on for today. Let me go to this. 2 speakers left, and that's it. We're going to give another $497 course away. So let me make myself the organizer. Great day so far. Remember, guys, I personally picked the people to speak today. So hopefully you guys are enjoying it. Hopefully you're learning a lot. Knowledge is power, power is knowledge. The most important thing, I always say it all the time, the most important thing actually is not to make money. The most important thing is to learn, because if you're not learning, then you're never going to make money in the long run. Any trader can get lucky in the short term, but if you want longevity, there's a reason. Foster was traded for what, 30 years? Foster's been trading for longer than I was born. I've been trading for 14 years. So, it's really, really important to understand, invest in your education. Make sure you guys, know what kind of trade you want to do. This is a list of presenters today. We have 2 more presenters. We have Mika, who is an Apple trader. He specializes in swing trading Apple and Google, which will probably tell you what he thinks is Apple right now, because it did pull off on earnings, or Google. Google got up to, what, 607 and closed at probably down 50 or 60 bucks from the highs. So this will be a really interesting presentation here. So we're going to bring him out here in a minute. I'm going to give away another $497 course. We're going to give away $5,000 worth of stuff. If you guys can make it all the way to the end of my presentation, I'm going to give away like $2,000 worth of stuff alone. Okay, it's my products. I can do whatever I want with it, and I just want to give stuff away for free. I'm going to give away T-shirts. I'll give away hats. I'll give up courses. I'll give you guys indicators. I'll give you guys the trading room. So if you guys can make it to the end of my presentation, I'm going to spend like 10 minutes just giving thousands of dollars of stuff away. So let me ask a question here. The first person to get it right, $497 course, and then I'll bring our next guest, Mika, on. And that site does work. It just is taking a little load. We're probably crashing the site with how many people are going in. So make sure you guys get into that. The option pit one does work. So let me ask a question here. Exports. This is a good one. Okay. So the first person to get this question right will win a $497 course by me, myself. The question is, which country exports the most amount of bananas? Which country exports the most amount of bananas? We have not got a right answer yet. Oh, we do have a right answer. The answer is Ecuador. Quito being the capital. So Ecuador is the right answer. So whoever said Ecuador first, and I show you guys here so you know I'm not making this stuff up. Oops. Ecuador is the right answer. Ecuador exports the most amount of bananas. Interesting fact you learned today. And I have to go back down. Hold on. Let me stop the last recording. Sorry, guys. I have to... Give me a second here. The answer is Ecuador. I have to see who found it. I saw someone get Ecuador. Okay, so the first person to get Ecuador right gets a free course. $497 value. It's a 10-hour course. You can choose any course you want. And I'm still looking for an Ecuador. Jamie Green. Jamie Green was the first one to get it right with Ecuador. So Jamie Green, congratulations. You won the answer with Ecuador. Jamie Green. So just email me any course you want. You will get it for free. You can personally email Jamie Green, $497 course, 8 to 10-hour on-demand course from us. Just email me and we'll send it to you. Okay, let me bring on our next presenter here and give you a little bio, and then it will be all of his. So let me make you organizer. Oops. Jamie Green. All right, it is all yours, Mika. Let me give you a quick little introduction here, and then we will go on. We're right on schedule. I'm really, really happy with this. I've gone to some webinars where people they're not on schedule forever, and it is a nightmare. Like you'll have guys that show up half an hour late. We're 6 minutes late. I think that's awesome. So Mika Lamar, did I price that or not? Lamar?
Yeah, you got it right.
That's right, Mika
Micah.
Lamar. Yes. Are you Israeli too?
No, I'm not.
Oh, I thought you were for some reason. Anyways, CEO of Apple Trader, AAPL Trader, and Wall Street IO, Mika Lamar is an expert stock and option trader with a specialization in taking complex cycle analysis indicators and breaking them down to easy-to-follow steps. Mika is also authored the Wall Street IO Stock and Option University program. Mika is most famous for writing the #1 rated Apple Investment Strategy Guide. This book covers the 7 steps to boosting your swing trade profits in Apple and Google. These 7 steps will be covered today's presentation. So a little thing, from 2006 to 2009, I was the largest independent Apple trader in the world, and this is how me and Mika got, kind of linked together. I will always have a heart in my place for Apple. I made almost $1 million in 2 different years trading Apple. I traded for earnings all the time. I do not swing trade it as much. I do day trade it a little bit. It is my heart, my soul. I have every iPhone, iPad, iProduct possible. I mean, I have an iPad that just sits in my cabinet as soon as I want on an iPad. So I'll be listening to this presentation, paying close attention, because I'm kind of intrigued where Apple's going to go next, and Google too, especially as Google ran up. It might be testing the gap down here. Ran up from back down about $60. So Mika, it is all yours. Enjoy, and make sure you guys stay until the end of my presentation in about 2 hours, because I'm going to give away about $2,000 worth of swag and courses and indicators for free. It's all yours, buddy.
All right. Thank you so much, Andrew, for the warm welcome. I remember when we first met a couple of years ago, and I specifically found you because of your history trading Apple. I remember I had interviewed you on my podcast and really enjoyed that, and so far we've done some great things together. Again, really appreciate you putting this weekend trading summit together. I've been listening in to some of the presenters today, and I've been taking some great notes. So big shout out to the whole Keen on the Market and Alpha Shark team for putting this together. Big thank you for that. Today we're going to cover how to use Apple and Google's natural swing cycles to increase your probability. It also works great on some of the other great swing trading stocks. Tesla's another really good one. Let's see. All right, so a real quick just disclaimer, Wall Street IO and myself, we're not a registered broker-dealer or investment advisor, either with the U.S. Securities Exchange Commission or with any state securities regulatory authority. We're an educational platform, not a trade advisory service. What you're going to learn tonight, you're going to learn the #1 trigger for entering into swing trades with Apple and Google. I also like to use it on Tesla. Tesla was actually one of my biggest trades of the year this year so far. You're also going to get the 7 steps. These are something that Andrew mentioned a little bit earlier. I wrote a whole investment strategy guide on these specific 7 steps, and I'm going to go over them, each one, in a lot of detail for you today. Okay, so if you don't have a notebook or a pen and pad or anything like that out already, you probably want to take a minute right here in the beginning to go and grab a notebook, because you're going to want to take notes on these 7 steps specifically. Okay. We're going to talk about how to use probability stacking, which is essentially stacking multiple confirmation triggers on top of each other to increase your swing trade probability. And that same methodology can also be applied to a lot of other types of trading. We're going to talk about where Apple goes from here. You know, we've had basically 6 months of sideways action in Apple. We've had some nice cycles, and we've had some really bearish cycles. I'm going to show you how to apply these 7 steps, and also how to use seasonality. Apple generally does really well in terms of its seasonality. We'll show you how to track that seasonality and much more on the webinar today. Okay, so who's Michael Lamar? This is me and my wife hanging out in Vegas with the Najarian brothers. I'm a husband. I'm a CEO of Wall Street IO, formerly Apple trader, expert stock and option trader. I'm a mentor, and I'm a coach. So let's go ahead and get started. I've got a ton of things to cover today, so we're going to probably move pretty quickly through a lot of them. I want to kind of get an idea of where the community is listening in today. So I want to understand a little bit about what camp you're in right now as a trader. we generally find when people come into Wall Street IO that they generally fall within one of the three camps. The first one is that you're making big wins, but you also have large losses. You're overall kind of flat. Of course, it's a little frustrating. Or you have slow grinding losses, which is even more frustrating. Generally leads people to giving up in the market.
Can you guys
the
all
last
see?
camp is that you're actually making consistent wins.
Can you guys see a screen?
Account, which is sweet. And after interviewing a lot of people and surveying a lot of people as they come into our community, we found that about 35% of the people who come in the first week, they're usually making big wins, big losses are overall flat. 40% of people are actually getting slow grinding losses. 25% of people are actually making consistent wins and growing their account. And our goal with our community and with this webinar today is to move everybody into the third camp. We want to get everybody to start making consistent wins. And if there's one thing that everybody took away from today's presentation, it's when not to trade. And I think that a lot of times we tend to want to overtrade. We have this thought like we need to constantly be making trades and constantly be putting our money to work. And today I'm going to show you some ways to do that, but also ways to protect yourself so that you don't overtrade as well. Okay, so my promise to you and everybody listening in today is that today's webinar will make you a better trader no matter which camp you're in right now. So even if you're already in the camp 3 and you're making consistent profits, hopefully some of the steps that I'm going to show you today will make those profits even better for you. Okay, so to do this, we need to take a look at everything in chunks. The first thing we're going to do is we're going to look at the actual signals. And then second, we're going to look at an actual case study so that I can show you how I've applied it. Okay, so far sound good? Everybody with me so far? All right, so question for the community. What is the #1 trigger for entering into swing trades in Apple? The answer to that for me has been payday cycle reversals. You might be asking yourself, well, if payday cycle reversals are the #1 trigger, what exactly is a payday cycle to begin with? Okay, so a payday cycle is a 6 to 12 day directional trend in a stock. It doesn't just need to be with Apple. It doesn't just need to be with Google or Tesla or any of these. It could work really great on a lot of other stocks as long as it cycles. What you want to stay away from are stocks that tend to whip around a lot, stocks that only go in one direction for 1 or 2 days at a time before doing a big reversal. You want to essentially look for stocks that are cycling. I'll show you in just a little bit how to find those specific stocks, what to look for and what not to look for, or what to look for to stay away from, essentially. Okay, so the question is, how do we find payday cycles? One of the things that I like to use as far as a tool is I like to use the Heikin Ashi chart. You may be familiar with it, you may not be familiar with it. Essentially, it's going to smooth out the trend, help us see a little bit more about how a stock's character is and how a stock naturally cycles. So I've grabbed an 11-month time snap of Apple, and the reason I grabbed this specific time snap is because it shows both downward trends, neutral sideways trends, and upward trends. You can kind of see that here. All right, so when I flip this over to a Heikin Ashi chart, it's essentially taking the same exact time snap, where you can see here we're looking at a candlestick chart, and it changes it to the Heikin Ashi chart, which is essentially a chart that smooths out the trend. You can see it's a little easier for you to visually see the direction the stock is going, the momentum the stock is going, and for me, I'm a very, very visual person, and it helps a ton for me to visually be able to see in the chart from a swing trading perspective which direction it's going. Okay, so the Heikin Ashi essentially smooths out the trend. This screenshot is grabbed from Thinkorswim. They've got the Heikin Ashi chart. I believe there's also some other tools and platforms out there that have the Heikin Ashi chart for you as well. Okay. Now I'm going to zoom in a little bit. You can see this is a 6-month time snap, so I've kind of taken that 11-month time snap, zoomed in just a little bit. Again, you can see that Apple generally cycles fairly well. The thing to remember is that Apple cycles up and it cycles down. I think one of the things that we have to remember is, especially with a company like Apple, who makes great products, if you're an Apple fan, you may have a lot of Apple products, and you may have this thought in the back of your brain like, okay, well, Apple's always going to go up. I love these products. I'm going to get tied to the stock, and I'm only going to be bullish on the stock. As you can see from just this quick little time snap, the stock cycles up and down, and we need to use some kind of timing mechanism or visual representation to tell us when it's dangerous to get long and when it's a little bit less dangerous to get long, when you have a better chance or probability of making some dough to the upside, as well as seasonality helps a lot. So let's go ahead and zoom in on this time snap. But first, a quick little trader fact. I found that swing traders make the most amount of money when they enter their trades at payday cycle reversals. Now, this limits the risk and maximizes the reward. Now, it's very jargony in the stock market world to say, well, you want to limit risk and maximize reward. Well, of course you do. That's really cliche to say. Today, I'm actually going to show you how exactly this does this. Okay, I'm not going to just leave it open-ended with, hey, limits risk, maximizes reward. That's really great, but today I'll show you exactly how that works. Okay. So where are the best trades located again, just to kind of get a filler out in the community to make sure everybody's with us today? They're at the payday cycle reversal points, okay? So let's go ahead and zoom in to find those reversals. And when we zoom in, what we find are that there's actually 7 steps to a reversal in Apple, Google, and a lot of these other stocks, okay? The first step that we want to look for, and again, this is where if you don't have a notepad, you probably want to grab one. Okay, we're looking at a very zoomed in time snap here. You can see we have both a upward bullish payday cycle here and a downward payday cycle. I'm just noticing my mouse may be a little small for people. I'm wondering if I can make this a little bit larger. All right, no worries. You can see we have two basic directions here, bullish cycle, bearish cycle. Now what I specifically want to make note of is what happened here at the end of this bearish cycle that could possibly give us a clue that the bearish cycle is over. One of the first things that I look for is a very simple indication, and that's basically, have we made a higher low? Said in another way, did we fail to break to new daily lows? Right, because generally when you see a trend and it's gaining a lot of directional momentum day by day, we continue to hit new daily lows every single day in a downtrend. And for the uptrend, you can see here, we continue to make new daily highs. Now, one of the first things that I look for, again, is when I want to get long and it's been bearish, I look for a failure to make new daily low, or said another way, a new high on the daily. And you can see here on the other side, when I'm long and I'm looking at getting out or possibly looking at getting short, I also look for a very similar thing, which is basically a failure to make a new daily high, right? Or said another way, a new daily low, right? So you can kind of say it both ways, but basically it's the same thing. Now, this first step taken by itself is obviously not going to be enough to get you in and out of trades. You can see here that there are several times where Apple actually made a new daily high, but ultimately did not end up reversing its direction. Okay, so this is just the first step. We need to take it in context of all 7 steps. Okay, the next step here is step 2. This is when a stock generally forms a reversal candle at some kind of support or resistance area. In this example, I use the bottoming tail hammer, and you can see that here. The bottoming tail hammer is basically a reversal in price. And candlesticks kind of tell you a bit about the character of the stock that day. You can see the price went all the way down to this point, reversed and closed to the upside, and the next morning we gapped up. That was a really strong sign to see that. Now, what you need to remember is with step 1 and 2, sometimes they don't happen in the exact same sequence. In fact, step 1 and 2 are often interchangeable and can happen sometimes on the same day. So sometimes you get a reversal candle like we just saw, like this. You can see that it actually made a new daily low, but it still formed a reversal candle, right? So sometimes these 2 steps are kind of interchangeable. It's important to try and recognize either one of them as a potential first step of a reversal, okay? Step 3, and this is where the Heikin Ashi chart really comes in handy. I like to look for the first green bar on the Heikin Ashi chart to show itself. And generally, you have to wait until the end of the day because sometimes it's green, and then if it sells off near the end of the day, it could close red, right? So you can again see that the first step of the Heikin Ashi, the first green bar on the Heikin Ashi chart, again, is oftentimes one of the very early indicators that we see before Apple makes a multi-day run or a run for 5 to 8 days, where of course we have to make the first green one first. Okay. Step 4, you can see it's actually the same exact chart. Step 4 is the first green bar or a first higher bar in the MACD. And similar to step 1 and 2, these can actually happen on the same day, right? You can see on this time snap of this chart, we have both the green bar on the Heikin Ashi and we have the green bar on the MACD. So that's a pretty strong sign that we're going to see some kind of reversal in the stock. Again, it's not completely confirmed yet, but you can see it's starting to look pretty darn good, okay? So again, similar to step 1 and 2, step 3 and 4 are often interchangeable and can happen on the same day, just like the example here. First green bar on the MACD, first green bar on the Heikin Ashi happened on the same day. I actually really like it when these happen on the same day because for me it gives a lot of additional confirmation, okay? All right, so step 5, and this may be a new step for a lot of people who are not familiar with some of the indicators that I like to use, specifically the ones on Wall Street IO. What I like to use for Apple and Google and some of these other big movers that tend to hold a trend for a week or more, I like to use 2 different moving averages, the 5 and the 13. Now these are not simple moving averages. They're double exponential moving averages. They call them DEMAs. These are also, as you can see, available on Thinkorswim. Obviously, Thinkorswim doesn't pay me to say any of this stuff. It's just simply the platform that I use, right? So what DEMA stands for is it stands for double exponential moving average. And essentially what that means is it means that it's going to move a little bit faster than your normal moving average. Whenever you have an exponential moving average, it's basically weighting the days in the moving average differently. So if you have a 14-day moving average and it's a simple regular moving average, it's going to weight all 14 of those days equally. When you have an exponential or a double exponential moving average, it's going to give the last few days that we just had more weight, which basically means the moving average is going to react faster to the stock, right? It's going to react faster to the stock. So what I like to look for, and I've played with this, believe me, I've played with this with about 1 million different combinations, and I found that the 5 and 13 work the best. I like to look for when the 5 moving average, which is going to be faster, crosses above the 13. And you can see it happened here to the upside, and you can see it happened here to the downside, right? So it gives you really great strength momentum indication on a very short-term time frame. Now, if you go into your charting software and start playing around with this, which I do recommend you do, play around with the different numbers and see if you can come up with something that works better. I actually challenge you, and if you do, make sure you contact me and let me know about it. I'm very open to hearing new things, okay? Now, as part of this, it's important whenever you're looking at some kind of trigger signal that you don't have a lot of false signals. And again, that's why I really like the 5 and 13 DEMA. As you can see here, it gives you a really clean sell signal and a really clean buy signal. It doesn't chop back and forth and give you a bunch of pump fakes, right? For everybody who ever played basketball, you know what a pump fake is. Basically, it's a false signal. And when you have an indicator that's giving you a lot of false signals, sometimes it's really hard to interpret and basically hard to follow. So anytime you're using any indicator signal, whether it's these 7 steps or anything else, it's important to make sure that you're not getting a bunch of pump fakes on that signal, okay? Step 6. Step 6 is we get the second green Heikin Ashi bar, and it goes about, I mean, it's really different for each stock. With Apple, since it's about, you know, $125, $130, I like to use about 15 to 20 cents. So if the second green Heikin Ashi bar goes about 15 to 20 cents above the first green one, that's a really strong signal, okay? And at the same time, we have the DEMAs crossing over to the bulls. With Google's a different beast. Because it's such a more expensive stock. So if you're using the same signals on Google, you want to go more like $1, right, rather than 15 or 20 cents with Apple. Now, when Apple was trading, you know, at $600 or above, you'd go with $1. But after Apple's stock split, 15 to 20 cents seems to work a little bit better. Okay, and again, you want to go similar with higher price stocks. It's basically, a $100 stock is going to move a little bit less generally than a $500 stock. So that's why that simple rule is in place. $1 for Google, 20 cents for Apple. I hope that makes sense. Okay, so again, step 6, you've got the second green Heikin Ashi bar going above the first one in Apple by about 20 cents, Google about $1. right? And if you think back, what we've basically accomplished is we've looked for the very first day, which is generally a higher low on the daily. We look for the MACD to go green on the first bar. We look for the DEMAs to start to cross over. We look for the Heikin Ashi to show its first green bar. We look for the DEMAs to actually cross. We look for the second green Heikin Ashi to actually go above the first one. Basically, what I've done here is I've broken down the very little characteristics inside of this specific period of time within these few days so that we can understand those characteristics so that we can look for them again in the future, right? Because if you think about it, getting short here is obviously not as good as getting short a little higher. And on the flip side, right, let me go back to my slide here, getting long, maybe on the second day, obviously has a lot less risk than getting long 5 or 6 days into a payday cycle, right? We want to limit the risk and maximize the reward. And again, you do that by getting in closer to that reversal point. Now, obviously, there's going to be a little bit of what I call opportunity cost, meaning there's, with this strategy, you're not exactly getting in at the exact low, right? Because there's no confirmation yet at that point. I'm guessing that when Apple was coming down here and sitting at the lows, everybody was still freaking out, right? And there wasn't really a really clear signal of buying yet until it actually reverses, and then we start to see some of these momentum indicators start to shift directions. Right? So again, the distance between the actual low and a good buy point is called the opportunity cost, essentially what your risk is, right? Step 5 and 6 can often be interchangeable, similar to 1 and 2 and 3 and 4, and can often happen on the same day. Now, the 7th thing that I like to look at here with Apple and inside these steps is the MACD lines that actually cross to the bulls. You can see that here. Now, I put this as step 7 because it's oftentimes one of the last things to happen. Right? The MACD tends to be a little bit slower, but when it does happen, it tends to signal a little bit of a longer term bullish move or bearish move. Now, one of the things that you have to understand about the MACD and payday cycles is when the MACD is crossed to the bulls and when the MACD is moving up, you're generally going to have longer and better payday cycles to the upside. When the MACD, in some of the examples I'll show you in a moment, is crossed to the bears, which essentially means these lines are crossed and moving down, when the MACD is crossed to the bears and moving down, you're going to have your probability of success getting long Apple is going to be diminished, essentially. Right? MACD moving down and being bearish pretty much means that generally the upward bullish payday cycles are shorter. And I'll show you some examples here. If you take away one thing today and one thing only, is to use these indicators in a stacked method, but most importantly, to avoid getting long in Apple and some of these big Momo stocks when the indicators are absolutely saying the opposite thing, like, hey, we're looking at a compression cycle, or we're looking at a period or seasonality where Apple or the stock is generally a little bit more flat to bearish, which I'll show you again in a moment, or when the MACD's cross the bears and trending down, maybe not the best time to get into a really aggressive call strategy or bull call strategy, right? Because the probability is simply stacked against you. I'm going to show you some great case studies here in a second, okay? So you can use these 7 steps to manage your positions, protect your profits, and if anything, to help keep you away from trading when it's dangerous to be doing so, right? You don't want to be getting in a really aggressive bullish strategy when seasonality is against you, the DEMAs are bearish, MACD is bearish, Heikin Ashis are red and moving down. Obviously, that's not the time to get into a very bullish strategy, but you'd be surprised how many people do so, and then they wonder why they lose, simply because they're not trading with the natural swings of the stock. Okay, so if anything today, would love to get people aligned with these because essentially these swings are happening already anyways. Why not use them to our advantage, okay? But to do that, I think you have to kind of break them down into chunks and understand the steps and the character of those chunks so that we can basically identify them, okay? Now, here's a 6-month daily chart of Apple again on the Heikin Ashi chart. Now, what I've done here is I've basically highlighted some of the big reversals here that you see over the 6-month time snap, and there's essentially 9 triggers. You can see them here. 1, 2, 3, 4, 5, 6, 7, 8, 9. Right, 9 signals in 6 months. So, you know, a little over 1 signal, not even 2 signals a month. Otherwise, that would have been essentially, 12 bullish signals. in 6 months, right? But we only had 9. Okay. Now, when we look at that time snap, 7 out of 9 of those were pretty massive winners. That's about a 77% probability, just kind of using this very simple 7-step sequence. Okay. Again, 7 trades here. You can see how well these bullish payday cycles were, how well they worked, and again, keeping you out of trouble so that you're not getting long during the bearish cycles, getting long during these bullish payday cycles. Okay. So again, the question that I often ask people is, are you over trading right now? And when you look at this again, 7 trades, 7 wins out of 9 trades in 6 months. So for me, I'm probably only trading Apple, a couple times a week, maybe making adjustments to my positions, kind of getting in and out of positions. A lot of people would probably prefer to be trading a lot more, but for me, I really, really like this probability stacked approach using payday cycles. And if that means I'm going to be taking less trades, I'm fine with that, because it means that the trades that I do take will hopefully have a higher probability of success, but you have to kind of have some patience and wait for it. Okay. So again, I think a lot of people tend to overtrade with this specific strategy. Okay, you want to make sure that you're waiting for that nice timing mechanism. Okay, now I want to go over a quick case study, and the reason I do this is to show you how to kind of combine all these with actual trades. Okay, so the trade I want to go over is a bull call spread that I got into in Apple. Essentially, we had a nice gap up over earnings. All of the cycle indicators that you can see here are bullish. The DMAs are bullish. The MACD is bullish. We've got a nice little gap up here, and after the gap, I entered into a 124 by 130 bull call spread. That was a 6-point spread, right? And it was an out-of-the-money spread. It was an extremely risky spread, but the risk-reward was manageable. I'm going to go over that in a second, and it gave me tremendous upside and how I was basically able to attain such great percentage, nearly 300% upside on this trade. So it was only $79 for the contract, and a lot of people come, they're like, oh, well, I only have $5,000 in my account, or $25,000, or $100,000, or whatever it is. People think that they have to have $1 million to trade Apple. Well, the spread was only $79, the contract, right? Okay, so it definitely goes to show that you don't need to be, a millionaire to trade anything like this. Okay. So again, 124 by 130 bull call spread, $79 a contract. I sold it a couple weeks later after these 2 great bullish payday cycles. They're back-to-back bullish payday cycles, and I got $295 a contract. It's about 275% gain on the trade. And again, you can see all of the cycle indicators were bullish this whole time. The DMAs, in fact, never actually crossed the bears and closed there. They stayed bullish the whole time. The MACD rolled down a little bit, but you can see the MACD was crossed the bulls and trending higher the whole time. And for the most part, we were consecutively hitting new daily highs. Okay, so again, something that I look for. So let's take a closer look at the spread. I get a lot of questions about spreads. I generally like to do spreads. Occasionally I'll do the plain long call or long put, but again, spreads tend to work really well. Let's take a look at the spread. So if you're new to a risk graph, don't worry. I'm going to go over it real quickly for everybody because I think it's so important to understand risk. And to do that, we have to use, for me, we have to use a visual representation. I think visually it's easier to see risk than just looking at a bunch of numbers. So nonetheless, here's a risk graph. You can see I went ahead and highlighted the risk here with a red box. Again, that was $79 a spread. And the reward here with the green box. I hope you can see that the proportions here are very skewed in my advantage. Reward was $521 max profit. Risk was $79 risk. Right, so you can obviously see a massive skew in the risk reward to my advantage. Now that said, we needed to see a massive move to the upside, so we literally have to get right in the beginning of a payday cycle and ride it for a little while for this trade to really work out. Otherwise, if it just went sideways, the trade would not work out. You would have lost your dough, which again is why it's important to use seasonality, MACD, all of these things that I'm teaching to make sure you don't get into aggressively bullish trades like this during the wrong phase of the stock. Okay, so a little bit of a law of spreads here, and this is great for anybody who's ever wanting to trade options. There's laws that govern options and option spreads, and it never changes. Essentially, here it goes. If you've got a vertical spread and both strikes are expiring in the same month, right, like I had, it was a 6-point spread. Both the risk and reward will have to equal $600. Because it's a 6-point spread, it has to equal $600. So if you have the risk, which is 79, plus the reward, which is 521, you have to get $600. It's the law of vertical spreads. It's simply how it works. So if you ever come to me and say, hey, Mike, I'm looking at a 6-point spread, the risk is $79, I automatically know you've got a $521 reward. Or if you come to me and say, hey, Mike, I'm looking at a 10-point spread, my max reward is 800. I know that your risk is 200. Right off the bat, I know that because there's a law that governs the risk and reward of vertical spreads, and it's basically saying that the risk and reward have to equal the size of the spread. So a really quick little trick there for you, for any option traders out there, basically how that works. So it's, again, a good way for you to be able to learn this quick law and in your head quickly calculate risk and reward setups a little bit faster, knowing that this is one of the components that rules vertical spreads. Okay, so again, looking at the spread, $79 here, $521 here. Okay, now for anybody again that's new to the risk graph, here is how this works. Okay, on the risk graph and almost all risk graphs, essentially what you're going to get is you're going to get the dollar value here on the left side, right? And you're going to have this gray dashed line here that shows the zero, right? $0 level. Above here is profit, below here is a loss. So you have your profit and loss on the y-axis right here. Okay. Along the bottom, you have your stock price. So as the stock goes down, this red dashed line moves to the left. As the stock goes up, the red dashed line moves to the right, basically moving left to right as the stock price goes up and down. So you have your stock price across the x-axis. Okay. Now this red line here that you see, this basically tells you the profit and loss of your spread on the expiration of the spread. Okay, when the options expire. Now, most risk graphs will only show you this information, which I think is very misleading, because you can see the next line I'm about to show you, this white one, tells you where you are right now in reality of the spread. It also helps you model future price and volatility changes, but nonetheless, you have to know where you are right now. Simply looking at the risk graph of something that's going to expire in a month or 2 or 6 months is, I think, a bit misleading. And if you ever look at the risk graph without the white line, just note that you're missing a critical part of information there. Okay, so again, the white line shows you P&L right now as of today, and if you have a good risk graph software, you can even model time change, you can model volatility change, you can model a lot of really great stuff. Okay, but again, this is how the risk graph works. So again, max reward 521, max risk 79. People often ask me for these kinds of trades, why does it accelerate so quickly in profits? And there's one word behind that, that's gamma. And I don't want to geek out too much here in options, but essentially gamma is the accelerator. And here's an example. Okay, here's a trade with a bull call spread, and you can notice this white line has a great little curve to it, and it moves up really, really fast. When you're gonna get into a very aggressive bullish trade, and you know that the stock tends to go cycle for 8 days, and you're getting in on day 2, you've got, let's say, 6 days before you want to exit the trade. There's really no point for a 6-day trade to go 5 or 6 months out with these options. In fact, I think if anything, it's going to hinder the trade. Let me show you that. Okay, so again, here's a bull call spread that is only a couple weeks out. And here's the spread if you go too far out. Essentially what happens is your white line that governs your profit and loss, when you go too far out, the white line is very linear. It has no gamma whatsoever. Gamma is, again, the accelerator. When you have a little bit shorter time, you have a great J curve up. You got this J curve, or they call it the hockey stick, right? You've got this nice little S curve, and you get the acceleration in profits, which means every dollar the stock moves up, you're actually making more and more money. But if you go too far out in time, like in this example, you might as well be buying stock because your white line is linear. There's no acceleration to it. So again, I don't want to geek out here too much. We cover all of this stuff in crazy detail in our options course, but this is just a little taste. And again, it's important for you to know because a lot of people ask, well, how far out should I go? Should I buy in the money or out of the money? Should I buy 4 months, 8 months, a year? Should I buy 2 months? This is all really important information, and as you can see by this little example, it's critical to understand these components. I think one of the presenters earlier said, you have to understand the mechanics. If you get into a car and you don't know what the D, R, and N is on the gear shift, you won't be able to drive. So it's the same thing with options. If you don't understand the option mechanics, then you're going to be at a disadvantage. So you have to understand these components of how options are priced and how they interact with time, okay? So again, here's gamma, no gamma, okay? One thing to watch out for, and again, remember earlier I said, if you took away anything today, it's when not to trade or not to be aggressively bullish in Apple. This is it, okay? Remember I talked to you earlier about the MACD, and I said, hey, look, when the MACDs cross to the bears in Apple, your likelihood of being very successful getting bullish on the stock is going to be diminished. And that's also true for compression phases. Now, oftentimes we see the MACD actually cross to the bears right in the early stages of these compression phases and then cross back to the bulls near the end. Now, it's really clear for me that Apple moves through several phases. Two of the main ones are an expansion phase, like you see here with this double bullish payday cycle, and compression phases like you see here. If you try to get into the same trade that I just showed you in that bull call spread, and you tried to get into that trade during this compression phase, oh boy, you would have lost some dough. It was very clear that this was not going to work because, check this out. Here's the same time snap. I didn't change that rectangle at all. You can see what the MACD was doing during that phase. MACD had crossed to the bears, and as Apple was kind of going sideways, a lot of people thought it was going to keep rallying, but guess what? When the MACD's crossed the bears and it's moving down, you just simply have to know that the probability of success getting long the stock for any kind of short-term trade is diminished. Okay, and again, if I could save everybody here, the one thing, or have you guys take away the one thing here, is please do not get aggressively long Apple in any kind of short-term trade when the MACD is bearish. Don't do it don't get bullish, okay? And again, that's the one thing that I want people to definitely take away from today, okay? And again, here's another example. I've got lots of these examples because the stock does this all the time, a few times a year, right? Again, huge upward payday cycle. This is actually the end of the cycle we just looked at. Moved into a compression cycle. There's still some decent swings in here, but certainly not as great as this one. And look, the MACD was crossed and nasty most of this time. Okay, so again, you would have a diminished probability of success getting aggressively long Apple with short-term calls during this phase of the stock. And if you look at